Hello, friends. Welcome to Nirmal. I am Piyush Jain, and today we are bringing to you a corporate conversation. A company which is into automotive sector has a very long legacy of more than 40 years. The company has recently made a very strong transition into the upcoming new energy space, which is the electric vehicle space, and has also rewarded its investors with a strong run up again. If you take a look at over last many quarters, stock has really done well. Now the question is, we are talking about which company? The name of the company is Sterling Tools Limited, and it's my pleasure to welcome the management, Mr. Atul Aggarwal, the whole-time director of the company. Atul sir, welcome to the show.
Thank you, Piyush. Thank you for having us. Thank you.
Sir, for our viewers, I'll ask the first interesting question: how tough it was really for transitioning into the electric vehicle space, because you already actually are now one of the largest in the motor control unit space. You're supplying and also have taken very heavy market share there. So from being one of the leading players in fastener category, uh, already you had the clients, and now actually have transitioned into the electric vehicle space. uh, how really difficult it was this transition.
So Piyush, I'm going to go back 5-6 years pre-COVID. I think we had, when we saw Tesla succeeding very well, about 5-6 years ago, and we saw the success of EVs in China. We believe that it's a matter of time where India catches up and starts making inroads in the EV space. So about 6 years ago, we started. 5 or 6 years ago, we started, with the leadership team, with our director Jaideep Wadhwa and Anish Aggarwal. We started traveling a lot, identifying product lines which may be relevant for India, where the price points may be relevant for India. So, I can say somewhere there was clarity in our minds that the game is going to change, and whatever we are trying to do it's still doing strong. There's still a lot of runway for growth, but we have to add new product lines in the new energy space, in the electric vehicle space. So there's a lot of clarity, and once you have that clarity and the vision, execution becomes much easier after that. And fortunately for us, we had a first mover advantage in what we were trying to do in that. So I think briefly, we need a lot of clarity of mind and the vision to go and execute after that.
Right. Even actually, as I see, the manufacturing plants basically have been sort of installed in Faridabad. Like, how's the volume growth looking in the electric vehicle space to you? Like, is it so robust that you're already now planning to increase manufacturing facilities, or right now it is stepwise growth? How is happening?
So, let me talk about the EV industry for a bit before I get down to firm level at our firm. Our belief, our analysis over the years has been that the penetration for EVs will happen very fast in two-wheelers and three-wheelers. The second fastest adoption would be public transport. And I think the third would be the last mile delivery, the sub 5-ton vehicles, where the large metros will force EVs to enter the cities itself. The passenger vehicle industry will have a more gradual penetration. I think hybrids, Japanese would want to push hybrids. The Koreans and Chinese makers would want to push full BEV vehicles. And I think the commercial vehicle business, because of infrastructure need, because of the kind of environment we operate in, commercial vehicle penetration will be the last one to have any meaningful numbers coming behind. Now, keeping this in the background and keeping this in mind, we at Sterling GTEC, what we started to do was we developed motor control units for the two-wheelers and three-wheelers initially, and we've had tremendous success with our customers. We also have acquired customers in the three-wheeler space. We have acquired customers in last mile mobility and public transport. So I think that's why we had. So we could foresee this happening, and that's why we had products ready for the industry. Not only ready in terms of technology and pricing, but as you know, post-COVID world has been hugely hampered by supply chain difficulties. we were able to make some long-term bets and work with our supply chain partners worldwide to make sure that we were able to ramp up as per our customer needs. Um, and I think that was one big advantage we had vis-a-vis competition besides technology and price. So we were able to ramp up the volume required by our customers, and some of the customers have grown dramatically as you grown, as you know. I think that's one of the reasons where we are able to grow so well and grow fast. We were up 4x in revenue last year in our motor control unit business, and our guidance we have given already is we're looking at another 2x growth on top of that this financial year.
That's really positive. In fact, your capacity has already been expanded like almost 60-70% so far. Your technology partner, basically, GTech, is already doing quite well in the commercial vehicle space. From that aspect, what's your own expectation over the next 3 to 4 years? How is sort of volume growth looking to you?
So GTech is a very large supplier to the commercial vehicle space. Like you said, they didn't have a product ready for the two-wheeler, three-wheeler markets, but we started working with them to develop a product 4 years ago. Um, and I think that strategy paid off for us and GTech as well. We have a very healthy relationship with them. It, it was supposed to be in pre-COVID times, supposed to be a joint venture with Sterling holding majority, but I think COVID happened and Galvan Ladakh happened, and there was no FDI automatic approval post Galvan in May of 2020. So the JV could not be crystallized into a pure JV. It's more of a technical arrangement now, and where Sterling owns 100% of the business. But despite the change in the context of the relationship, our GTech continues to be a strong partner for us. We are developing jointly a lot of components for different makers in India, including existing customers. Piyush, I want to add that since we've been commercially operating, I would say for almost 20 months now. I think a commercial ops started sometime in October of 2020, but the volumes were very small. Um, and we have supplied a large volume of MCUs to our customers. So there's a lot of customization we are doing for our customers. We are building products jointly. There's a lot of codependence between GTech and Sterling to develop components as we go forward. So the relationship continues to stay healthy.
Very nice, sir. I'm really tempted to ask you because the revenue growth has been very strong. Like, look at the numbers here, almost 50% plus in the consolidated sort of revenue numbers here. We're talking about 50% plus growth. Uh, Within this growth, uh, what has been your observation on a strength of volume growth, and like what sort of volume growth will really make the company happy as per their own plans over the next 2-3 years? Like, are we expecting some 20-30% volume growth to remain very steady?
So in FY23, if I can separate the two businesses, fastener business and the MCU business, the fastener business grew by almost 28%, but the volume growth was more like 21% in FY23. In MCU business, that 4x growth came purely that was all a volume growth. So in terms of, so we grew from a revenue of 500 crores plus in FY 22, and I think we have done close to 775 or so. So it's largely the large part of the growth on a consolidated level came from volume, except in the fastener business, there's about a 7% growth which came on account of inflationary price increases with our customers. That would be purely commodity steels if we buy for our fastener operation. Going forward, I think we are roughly looking at about 30%, 35% plus growth this financial year. All of this is volume based. I think we're looking at 30% volume growth itself. So this growth this year does not have any inflationary impact built into it. It's purely volume growth. So we're still quite positive and hopeful of meeting these numbers this year.
You just have touched upon which I wanted to ask you on the inflationary aspect here. Last year actually also had a lot of inflationary impact. Um, this usually has two impacts. One, again, if it's supporting you, then it also leads to revenue growth. But if the cost is not in favor from the perspective of not able to pass through, it actually dents the margins. So one year has gone by. We are now actually moving into slightly more stable, calmer year. What's your own observation now with raw material prices slightly coming down? Are the margins looking better now?
So we closed in a fastener business. We closed our EBITDA margins at 15% plus in FY23. I just want to mention one mathematical issue which comes in calculating margin structures. For example, in FY19, our margin structures were high teens at 18-19%. We are down to about 15%. And I think about 2.5-3% is on account of the numerator-denominator effect. Our customers have compensated us fully for our steel price increase, which means that if my raw material content was, say, 40% earlier before COVID, that steel prices have gone up by almost 35-40%. My content has gone up from pure, and they compensated, let's say, 20 rupees a kilo. My selling prices went up to 120 rupees. And at the same time, my buying prices went up from 40 to 50 rupees. So that my overall RM content has gone up from 40%, say 43-44%, which in other words does not, but the conversions we are doing, the value addition we do in the manufacturing process, that has not been compromised. We are retaining all that. So like I said, a bulk of that is as a mathematical anomaly, which when the steel starts softening, which automatically will give us a double impact going the other way, positive way as well. Since Piyush, you asked me about the pressure going forward. Our belief is currently, we say FY24, we don't see steel getting any firmer. We don't. Our forecast for ourselves is that steel prices will probably be in range bound and will not have any major impact on our cost structures. We are currently trying to negotiate with our customers for giving us some inflationary price increases beyond steel, for example, energy, people costs, chemicals, etc. We are in negotiation, and somewhere we have already got some positive indicators, somewhere we are still under negotiation. But overall, I don't think I think the inflation dampener is behind us substantially. Going forward, we do not see this causing additional pressure on our balance sheet or our P&L.
Right. And so again, basically now we're thinking about a strong 30% plus volume growth story. Margins again basically are looking stable. So now the question is where we are right now in terms of utilization, both for fasteners and also for our electric business, the MCU business.
In terms of capacity utilization?
Yes, sir. So
in the fasteners business, we have done about 600 crores of revenue last year. And we have 3 manufacturing facilities supported by a steel processing facility, so 4 manufacturing locations. On an optimal basis, I think these facilities can churn out a revenue of about 850 crores at current product mix and pricing levels.
So we are operating roughly around 70% utilization. That's a good number, yeah.
Yeah. So we can reach on optimum basis about 850 crores. So there is capacity in our system to handling the growth. And for our MCU business, we are doubling our capacity, going to about 600,000 motor control units, and that capacity will probably go live by October this year.
Okay.
So both businesses have been planned, have been invested to make sure that we are able to crystallize the growth we have targeted for ourselves.
Right, and this 300,000 largely a brownfield expansion, because then the capex won't be actually as much as you would have invested when you were setting up 300,000.
Correct. I think it's a brownfield at the existing facility itself, and it's roughly I could be off by a few crores. It's a 30 crore capex for our MCU business, and a roughly 30 crore capex for coming also in a fastener business this year. For the fastener business, the capex, there is some for capacity addition. There is some capex coming for for balancing equipment, and there's some capex coming from engineering and a quality perspective. In our MCU business, 30 crore capex, substantial part of the capex is going for capacity expansion, and we are and a certain percentage of capex is also going into our strengthening our tech center in Bangalore. The MCU business, we have opened a tech center in Bangalore. The headcount there currently is about 30 people. We plan to take it to 70 people in that tech center in Bangalore by the end of this year. So a lot of investments also going into the tech center to adding tech capabilities in software and hardware design for the components.
So just if I have not missed, in the MCU business, at present, what's the utilization you're working on? Like the 300,000 ton, 300,000 capacity. For that, basically, what would have been the optimal revenue?
Optimal revenue on a 300,000 basis would have been more like 250 to 275 crores.
Okay.
But our own internal forecast for that business is about 350 crores, we say.
Right, and that's where you're expanding because I started wondering, you're around 120 crores if I remember the number rightly, and the full capacity would be around 270 crores if you're saying, and if you're already expanding, that is telling me inside that you are seeing very strong undercurrent in the demand.
Yeah, no, so you're right. In FY23, we did 175 crores in our MCU business, and we are forecasting 350 against that this year. Yeah. So we are forecasting a very good demand, but if I can, maybe I shouldn't say this, but let me just say the only blooper being that FAME 2 subsidies have been corrected as of 1st of June this year. So there's going to be some realignment, there'll be bump in the road in the for this quarter, maybe for a couple of months where the prices align, and as you'll see the numbers coming out in July as to who the large EV makers are and what's happened to their numbers of sales just for the month of June compared to April and May.
Sure, we'll keep an eye. But the best part is, I think, which a lot of viewers, they normally actually are not able to spot. So I think it's good to actually spot that you are investing only 30 crores, right? And that's why the brownfield expansions are so beautiful. That with 30 crores sort of investments, we are largely now targeting another addition of about 270 crores, optimal again at the peak utilization, and that's why the brownfield expansion generates the best asset turnover. So you actually are talking about almost 8 to 9 times when we reach the full utilization. And I think that will speak well also on the ROI, ROC as you go 2-3 years down the line.
So Piyush, I'm glad you mentioned ROCE numbers. Our MCU business ROCE for FY23 was close to 35%. It's a very attractive business from a ROCE perspective. And next year, if all goes well, we are looking at a 40% plus ROCE in that business. So, which is
40% plus, sir?
Yes. And
so when you reach the full utilization in the new electric space, I think that perhaps could increase further. So actually, the news here will be that when this starts increasing, you also actually start generating possibility of re-rating the PE, because that has to catch up with what returns you're generating.
Yeah. So you're right. I can't comment on re-rating of the PE. That's not.
No, that's my comment.
Yeah. But having said that, we can. We are, like I said, we were at 35%. We're looking at 40%. There's a lot of, despite the growth, we investing a lot into our tech capabilities. Both, like I said, in hardware and software design. Idea is to have those capabilities more in India and decrease the dependence on China for these particular technologies. And the Indian supply chain is also getting more robust to handle these products.
Right, sir. And sir, as we move towards our last few questions, what is sort of borrowing we are working right now?
So, in a fastener business, our net debt is about 50 odd crores. We have on a 600 crore revenue. If I do a net debt calculation, which is there, is about 50 odd crores only. There's a large treasury operation. At the same time, we have borrowings from three different banks. So our net debt is only 50 crores, which will give you an idea. We are trading and we're at 0.1 number.
Yeah, it's 0.5 to EBITDA, and that will keep increasing. So it's actually very low leverage.
Yeah, and in our MCU business, our net debt is roughly pure from a fund base and a non-fund base. A lot of our supply chains work on letter of credits, so there are large amount of letter credits open. But I think that net debt there, I think we borrow roughly about 25 to 30 crores at any point of time in that business. And that too because the supply chain is very international. Components come from all over the world. So, and plus, like I said, the supply chain was hugely damaged post-COVID. So we took some aggressive points and we bumped up our commitments to our suppliers and our inventory levels to make sure we were able to ramp up our revenue numbers.
Okay, so just to check if I was able to actually take the numbers rightly, when you said the 50, it was the consolidated net debt, or it was only for the fastener business?
Fastener net debt, 50 crores.
Okay, then 50 and 30, so like around 80 CR net debt for the entire business.
Correct, that's right.
Okay, fine, sir. I think that's pretty much comfortable. I think it's something I think which viewers can keep tracking, keep studying on it.
Yes.
As we close, sir, like my last question, and with that we close. On a FY24 basis, the exit June quarter or the so far whatever order pipeline you are seeing right now, what are clients saying? Like, what are you drawing as a conclusion toward the first signs from the international markets and then domestic markets separately?
So, Piyush, let me talk about domestic because bulk of our revenue, 95% of our revenue comes from domestic. I'm saying it myself. I think the weakest link in our revenue profile is our export. Numbers are very small from where we are, so we're working on that. But I'm going to focus on domestic. On the fastener business, we work with all the OEMs in India across all segments. For example, in two-wheelers, we work with Honda and Hero MotoCorp, and in passenger vehicles, we work with Maruti and Mahindra, and now we started Hyundai. In commercial vehicles, we work with Tata, Leyland, Daimler, Volvo, so we have a large presence there. And for tractors, we work with Mahindra and John Deere. So industry-wise, if I look at it, tractors are not expected to grow very much. I think we're looking at a 2-3% growth. Commercial vehicles was looking to a substantial growth this year at about 10 to 15%. But the first quarter is not looking that attractive. It's still grown over last year, but the commercial vehicle numbers on growth are not online for the full year. And we are hoping things pick an upswing again. In passenger vehicles, the numbers are expected to grow by 5%. But having said that, both our customers, Maruti and Mahindra, will probably grow faster than that because of the model launches, etc. The industry is expected to grow on that. On the two-wheeler space, we have Honda, which is expecting to grow at about 15 to 20% in volume this year, and Hero MotoCorp. So the industry is not looking what it was in FY23, but because of our customer profile having market leaders in each segment, we hope to grow faster than that. I think we are still optimistic on doing the numbers we had projected for ourselves this year. On the motor control side, EV business, despite we are still on track to do 2x revenue this year, about 250 crores in FY24. Despite the bump we see right now going through in the FAME to subsidies being dropped by the government of India to customers. But the customers we work with are large players. They are fully invested. We also have PLI schemes behind them. They are quite comprehensive in their engineering capabilities. So even the customer profile we have there, we believe that we'll be able to meet this numbers of 2x growth this year.
Well, I would say, I think, sir, those are one of the best insights, I think, in the automotive sector. So I think that is something which everybody is going to really appreciate. So thanks a lot for coming on the show and really enlightening us about your company, incredible growth, and very strong sort of future possibilities.
Thank you, Piyush. Thank you for having me.
And with that, dear viewers, it's a wrap on the show. Hope you enjoyed it.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.